Hello, greetings, and welcome to Dividend Blasters. This is our 86th video. Topic today, Gpiq, the Goldman Sachs NASDAQ 100 Premium Income ETF. This is a cheaper, higher upside alternative to Jepq and Qqqi. Let's get into it, but first a quick disclaimer. I am not your financial advisor. This video is for information and education, reflects my own personal opinions, my research, and experience as an independent investor for more than 30 years. Please do your own research, your due diligence, and consult a financial advisor prior to making any major financial investment decisions. Okay, a quick summary. This is a covered call ETF. They're actively managed. They're actively managed because they have a team that sells options, call options against their holdings. And they are holdings in the NASDAQ 100. Their objective is to provide current income while maintaining prospects for capital appreciation. That second part is very important. Prospects for capital appreciation. This is really one of the things that separates them from other covered call ETFs that forego that upside for distributions. They're fairly new, launched in October of 2023. They basically invest in stocks within the NASDAQ 100. NASDAQ 100 is a very tech-heavy index. Top three holdings are Microsoft, NVIDIA, and Apple. I talked about the objective, consistent income, and potential for capital growth. So one important thing, and I talked a little bit about the call options, they have a dynamic options selling strategy, an overlay strategy. And when I say dynamic, basically what they are doing is they have a variable approach to selling options. They don't sell options on all their holdings. They will vary it monthly between 25% and 75%. That is what's different here against other covered call ETFs that may sell options on all of them or almost all of their holdings. By doing this variable approach, they are not locking themselves into capping their upside. They are basically leaving some of that flexibility where they can benefit from price appreciation. And, we are in volatile markets. They go up and down, but when they go up, especially in the NASDAQ 100, they really go up. So they're leaving that uh, available to them, which is very nice. So when you invest in this covered call ETF, like other covered call ETFs, and you get your distribution, it's comprised of two pieces. You are getting dividends from the holdings, but you're also getting that portion of options premium income that they are collecting. That's how you were able to get higher distributions versus maybe just investing in a index fund ETF like QQQ or QQQM, which is going to give you great growth but very little distribution. I already managed that they're actively managed. They have the options overlay strategy. Uh, they typically will deliver around a 10% distribution, which is very nice. Sometimes a little above, sometimes a little below, but around 10%. Another thing that sets them apart is that low expense ratio, 0.29%, 29 basis points. So what does that mean? That means for every $10,000 you invest, you pay 29 bucks for them to do their magic. It is less than some of their peers, all of their peers, I got to tell you, which is very nice. I already talked about it's being a very tech-heavy index that they invest in, the NASDAQ 100. All right. So what I'm about to tell you here, you can basically apply this to any covered call ETF. Um, you have a trade-off between income and growth. The more distribution you get, the less upside you are going to be uh, getting. There's no such thing as a free lunch. That's basically what this is. So I believe, in my judgment, and I think that this is sound assessment, is they, through their dynamic options writing strategy, they are giving themselves that flexibility to get that growth and you're still getting a great distribution. This is quite spectacular in my judgment. Market sensitivity, yeah, I already talked about that. Basically, any covered call ETF, you are capping your upside to get that distribution. It's really a little bit of a trade-off. Uh, Volatility and premiums, you're getting the premiums because there is volatility. And the team that's selling these options, they will not be able to guarantee you a consistent growing distribution. It's going to fluctuate. It's still going to be high. They're still going to sell a lot of options, but it's not going to be the same every month. So you're going to get your distribution from the dividends, and just depending on how successful they are in selling options, you may get 10% on annualized one month. You may get 10.1% the next. You may get 9.9 the next. So it's going to vary a little bit. And this is to be distinguished from maybe an SCHD dividend ETF, which will continually grow the dividend, but they don't have an options overlay strategy. They're just basically collecting dividends from their holdings. So that's very different. And I wanted to draw that distinction for you. All right. So, just a little bit deeper dive. Gpiq closed at 48.12 on Friday, June 6th. You can see in the 52-week range, they're close to the top of the range. Again, that expense ratio is nice and low, 29 basis points. And for a covered call ETF, it's fairly cheap. It's a monthly dividend payer. So, dollarized, it's the yield is coming up to $4.97 per year on average, and that it's a trending 12-month estimate, so that could change a little bit. Could go up a little next month. So that trending 12-month yield is around 10.34%. That's very, very generous. Now, assets under management, these guys are not huge. They're a little under 900 million. And in the ETF game, it's not huge. In the covered call ETF game, that's still not huge, but they've only been around a little more than a year and a half. So they've had really decent growth, and my expectation is they're going to continue to grow. So I did mention that these guys invest in the NASDAQ 100, which is a tech-heavy index, and you can see that the breakdown of the holdings that they own are mostly technology from the tech sector, so a little over 52%, followed by communications and then consumer cyclical in a distant way. And then here they are by holdings. I mentioned the top three are Microsoft, Nvidia, and Apple, and those will fluctuate because we've seen the market cap of those top three fluctuate. And then, Amazon, Broadcom, Meta Platforms, Netflix, they tend to move around and about as well. So what I do like here, and what this chart shows you, is that their total return, and when you're looking at a covered call ETF, it's not really helpful to look just at price return. It's good to look at it, but that's only a piece of it. You want to get some price return. You want to get some of that upside that I talked about. But the total return is really helpful. And if you look at the 1 month total return, it's over 8%. Compared to all ETFs, it's double. Okay, 6 month total return, it's more than a percentage above. 1 year total return, more than 5 percentage points above all ETFs. Go down a little bit, then you can see the price return. It's still above, okay, in 1 month. 6 months, it's down below. But you know what? That's because the NASDAQ 100 has been having a lot of volatility. And when it has a lot of volatility, you like to get that distribution. So think of the distribution really as a way to mitigate your risk against market volatility. It's pretty good. They've performed well. I like their dividend yield. The dividend yield is a little over 10% right now. This is a trending 12-month measure, as I've mentioned, almost 5 times that of all ETFs. I got to tell you, though, this is not just against covered call ETFs. This is against all ETFs. So some ETFs don't pay any dividend, or they pay very little dividend, like the index fund ETFs, like the QQQ and the QQQM and VOO, which replicates the S&P 500. The dividend growth rate, that is a huge dividend growth rate, 80%. But I got to tell you, they've only been around a year. So that is phenomenal. I do not anticipate they're going to maintain an 80% dividend growth rate. I think it'll normalize in the next year or two. But we're going to watch that closely. All right. So just here's a dividend summary. I already mentioned the 10.34%, $4.97. Dollarized 1-year dividend growth. It's a monthly payer. On average, per share, it's 41 cents per share. So who are their peers? Well, what I'm doing is I'm going to compare them to 3 other ETFs, 2 of the leading covered call ETFs that replicate the NASDAQ 100 and sell call options against it, and then 1 ETF that replicates the NASDAQ 100 and doesn't have a call option strategy. They are QQQI, NEOS NASDAQ 100 High Income ETF, and Jepq, JP Morgan's Equity Premium Income ETF. And then finally, the index fund ETF, Invesco's NASDAQ 100, QQQM. Let's just take the assets under management. This, to me, is a major difference. Gpiq is the smallest by far. They're also the newest. Actually, no, QQQI NEOS is a little bit newer, but they're actually bigger. They're about twice the size of Goldman Sachs' Gpiq. Both are dwarfed by Jepq and QQQM. Those are multi-billion-dollar ETFs. Jepq's is big for a covered call ETF, a little under 27 billion. The index fund ETF QQQM, a little under 50 billion. And again, QQQM has no options overlay strategy like the other 3. So basically, there's a lot of set it and forget it, folks. And let me just say this. I own all of these. And I think owning QQQM is part of a great strategy for my portfolio. I will get more upside, but I'll get very little distribution. So I invest in the others, and I'm heavier right now in Gpiq than I am in the other 2. But that's because I think it's a little bit better. Right now it is. But there was a time when I was very heavy in Jepq, and then there was a time where I was very heavy in QQQI, and I've moved over to Gpiq. What else sets them apart? That expense ratio, 29 basis points. It is basically less than half of QQI's 68 basis points. It is less than Jepq's 35 basis points. It's a little bit more than QQQM's, but you're paying for the options overlay to get you that higher distribution. So check out the dividend yield. Dividend yield 10.34%. This is a trending 12-month measure. It is a little bit less than QQQI's and Jepq's. But again, you're giving up a little bit of the yield to get a little bit more of that upside. And we can see that in the next couple of slides I'm going to show you. All right. So if you look at the price performance, Gpiq performs very well in the last 1 month and in the last 3 months. And in the last 6 months, it does better than QQQI and Jepq. QQQM is going to outperform all of them price-wise, but again, you're not getting any distribution. That's the difference. So if you want to own an index fund ETF and a covered call ETF that is invested into NASDAQ 100 holdings, in my judgment, I go with QQQM and Gpiq. That's just my opinion. It's not financial advice. All right. So just here is the price return compared for year to date. And you can see they are essentially negative amongst the covered call ETFs. QQQM is slightly positive, but this is just price return. But of the covered call ETFs, Gpiq performs better than QQQI, and Jepq. QQQM performs nominally better, a little more than 3.6% price return. But let's look at total return. Total return, and this is basically where you're looking at price return and dividends reinvested. It becomes much closer. So GPIQ year to date, 3.42%. QQQI a little bit more, 3.61% total return. So QQQI does just a little bit better. But remember, you're paying even more for that. You're paying for higher with a higher expense ratio with QQQI. Jepq is still negative. So to me, I'm looking at GPIQ and QQQI, and I'm making a personal decision. You know what? I'm going to go a little cheaper with GPIQ and get very close to what QQQI is getting me. QQQM does a little better than both GPIQ and QQQI, but you're not getting any distribution. Okay, they're at 3.83% total return year to date. So something to think about. Okay. So what makes them different? And I've talked a little bit about this, but I got a nice table here. QQQM is their strategy is passive. Okay, they are just tracking the NASDAQ 100. The other three, they are writing covered calls against. And then you can do a quick comparison of the expense ratio. GPIQ is less than Jepq's and QQQI's. You can see what the yield is. Trending 12 months, you are getting a 10.34% yield with GPIQ. It's a little bit less than the other two. Okay, but again, look at that expense ratio. I think that to me, I like. And then what I really like is I'm going to be availing myself to greater upside in addition to getting that distribution. They have a dynamic options strategy where they will basically write call options anywhere from 25% to 75%. They never do 100% of their holdings to write options. So, and they will vary it just based on the market. If the market gets hot, they're going to basically pull back and maybe not do 75%. They may do 50%. They may be doing 25% because they're going to avail their investors to a greater upside. And then basically the other two are 100%. Okay, they write covered calls or calls against all of their holdings. They all track the NASDAQ 100. All right. All right, and I've already addressed this. And folks, that's it. That is it. I hope you found this to be useful and enjoyable. Before we close, I just wanted to remind you that I am an affiliate partner of Seeking Alpha. And as an affiliate, I can offer you a discount to different membership subscriptions. One is the Seeking Alpha Premium. Can get you a $30 discount and a 7-day free trial. Try it for 7 days. If you don't like it, you cancel. If you like it, and I think you will, you get $30 off. If you already have that and you want to, do a bundle, you can do that, and you'll get a $159 discount. If you only want Alpha Picks, where you are going to get a couple of free picks from our quant team at Seeking Alpha, you'll get a $50 discount. You can read a little bit of the details. I got it bulletized for you, and I hope you will consider joining Seeking Alpha. And as an aside, I've been a subscriber and a customer for many years, and I find this to be an invaluable resource. The links are here. You can click on them. I'm also going to provide them in the comments. I also have the QR code. You can click on it and go right to the subscription offer and sign right up. Folks, that is it. Thank you for sticking with me, and I hope you found this to be useful and enjoyable. I am also on other social media platforms, X, Instagram, and Facebook, and you can see my QR codes there as well as my handle. Have a wonderful day. God bless.